The Business Council and the Conference Board releasing their second quarter CEO confidence survey this morning, and it shows a drop in C-suite sentiment. Join us now, former Fed Vice Chair Roger Ferguson. He's also Vice Chairman of the Business Council and Chair Emeritus of the Conference Board. We can talk about that, Roger. I want to talk to you quickly about whether the Fed says we're just going to wait and see what's happened. This is a pretty big deal, what just happened in the courts. If it takes the tariffs off the table, or at least makes it less likely, seems like a good time to cut. We don't need to worry about inflation now, Roger.
Good morning, Joe. It's always nice to see you. I disagree with your premise. I think inflation is still something that needs to be watched very closely. For sure, it's good news if we aren't going to confront these tariffs, but it's not a done deal just yet. And so I don't think the Fed needs to be in a hurry to cut at this moment. I think they should still, at the next meeting, signal a wait-and-see attitude till there's even more clarity.
Yeah. I don't think the Fed has talked a lot about, or at least the media has played up the Fed talking about tariffs a lot, because they usually don't comment on things like that, fiscal policy necessarily. But I don't think that was the reason for not cutting anyway. I mean, the economy doesn't seem to be in a position where it needs an interest rate cut. And there's still the inflation we were worried about, at least half of it was still in the pipeline. It wasn't even tariff related. So I was just sort of I wasn't saying that that's why they should do it. I was just saying it sort of removes that premise that they were using it as an excuse why they weren't going to cut. Really, the economy is strong. There's no, the uncertainty we're talking about in the C-suite, where are we seeing that?
Well, to be fair, we're not seeing it yet. And part of what was going on, I think, with our CEOs, who did show a very dramatic move from optimism to pessimism, I think was a reflection just of the great policy uncertainty that they're dealing with, and not knowing exactly, what the set of rules were going to be against which they're operating. And so we'll watch and see whether or not this the collapse in CEO confidence turns around. But I would say that, we measured people both before and after the May 12th pause, and both of them showed, a decline in confidence into the negative territory. So I think there's something more fundamental going on here than just simply the tariff talk, even though I think that's part of it. It's really just trying to create greater clarity around the rules and regulations, around tax policy. There's just a lot of uncertainty right now, and CEOs that I think are reflecting that uncertainty, and it's broader than just tariffs.
Since we're so close to these levels that we've been talking about, we're just seeing a couple of basis points. Mm-hmm. These aren't big moves, but everything moved higher on the yield curve. Yields. The yields moved higher after this. How do you explain that? If it's less inflationary, doesn't seem like yields should be moving up, or does it remove the growth concerns about tariffs so that rates go up?
Oh, no, I think the move on interest rates is very much predicated on the expectation that fiscal policy is not going to return to normality, shall we say. We're going to continue to run very large deficits, and those have to be funded and financed in the market. And I think it's a simple case of the market saying, we'll continue to absorb, the debt issuance that the Treasury is going to have to execute, right, but the price has got to be higher. Right. I don't think there's a mystery to that. I think it's basic supply and demand indicating, you keep coming to the market with these large deals, these large offerings, and you're going to have to pay up for it. And right, we saw it recently, a pretty disappointing, 20-year auction. So I think the market is signaling something there.
But then it calmed down, and all the 2-year, 10-year, and 30-year all dropped below those key rates for the last couple of days. I was just talking about overnight. All of a sudden, the tariffs become less of an issue and rates move back up. I mean, the debt and the big, beautiful bill, all those things have been around. We've known about that. I just wonder near term why that happened. We've got major funding issues with $37 trillion headed up to, I would say, a minimum of 40 over the next, I don't know, how long, Roger? When do we get to 40? It won't take 10 years.
No. It's well within 4 or 5 years, I think. And the market is projecting it. The market is expecting that. They see it, and they bring in the pricing. So I don't think we should expect, I believe, to see a yield curve that's roughly at these numbers for a period of time until there's greater certainty that we're going to be on a trajectory towards reducing, not increasing the deficit here. And that's, to me, a long way away based on everything that one could see today.
But overall, Roger, just in terms of this environment we're in, stocks are back, basically. Rates aren't, the worst case scenario hasn't come to pass. The labor market seems pretty strong. Is there any reason really to be overly concerned with anything except long-term debt problems? What's on your mind? I mean, things seem pretty good.
Things in a general sense, as you point out, seem on an even keel. But the reality is, particularly CEOs and other decision makers wake up every day trying to figure out what's the tweet of the day going to be, what's the headline going to be, what commentary is going to be made that may throw planning into a period of uncertainty. And, these are, as I talk to CEOs, particularly when it comes to capital expenditure, those are decisions that take 4 or 5 years to actually play out. And it's hard to make a long-term bet, a long-term investment decision in a situation that seems so fraught and so uncertain. Mm-hmm. And so while it's easy to look at a particular number and say, unemployment is roughly at full employment, inflation not yet at the 2% target, but still moving in the right direction, one hopes, one could pick up factoids that all should paint to a more positive picture. But CEOs are telling us uncertainty, frankly, emanating from Washington to D.C., is slowing down decision making and leading them in a position where they are far less confident than they were just a few months ago.
Yeah, well, it remains to be seen when that shows up in the data. Maybe the data would be much better than what we're seeing. Maybe that's the counterfactual, or but we've been waiting and waiting and waiting. Haven't really seen yet, I guess.
Well, look, there's a lot of forward momentum in the economy, and what this survey is saying is don't count on that to continue forever. Yeah. But this decision making is slowing down in the C-suite.